Hi, everyone. My name is Steve Seger, and I am the Director of Acquisitions and Investor Relations here at SNS Capital Group. Today, we're going to step back from the numbers and the communities to share something a bit more personal. We're going to discuss the origin story behind SNS. While SNS has grown into a vertically integrated investment firm managing thousands of multifamily units, it did not start that way. And behind the company is a story rooted in grit, resourcefulness, and a long-term vision. And in this conversation, I'm going to sit down with our co-founder and CEO, Jered Sturm, to talk about how he, his brother Andy, and their partner Coleman built SNS from the ground up. We're going to explore the early challenges that they faced, the turning points, and the mindset that continues to guide how we operate today. Let's get into it. Jered, thanks for joining me today. I'm real excited about the origin story video here we're putting together.
Yeah, I'm excited too. I think, I've had the opportunity to briefly hit on this in a lot of podcasts that I've done for other platforms, but usually we have to be pretty brief in that and just get on to the content of the podcast. So I'm looking forward to kind of digging in more and sharing some of my story.
Yeah, and I know we talk to a lot of investors that want to learn and understand what your background is and Andy and Coleman's. So I think this will be a good resource. So we can jump right in. We're going to go way back to the beginning, and I'm hoping that we can just do this in a more conversational format, just for the listener. But could you just walk me through your early years here in Cincinnati and what originally drew you to real estate?
Yeah, I think I got to go real far back to to make that make sense.
Yeah.
So early on, myself and my brother were not great academic students. Just school wasn't really our thing.
Yeah.
We were smart, but just didn't really enjoy the typical academic structure.
Okay.
And what that resulted in is us spending a lot of times in the woods, building tree houses, bike jumps, these types of things. And just kind of never really falling into the typical path of, let's say, corporate America, right? Even from a very, very early age, it was just school's not our thing. Our parents are great, and they kind of realized that from very early on, but were super supportive. So they were not the parents that were like, you need to get A's. Ultimately, they realized we need to focus where they do have strengths and make sure we're raising good people. And so they were the parents that were like, you got to get through school. C's get you through, and make sure you get your C. It's your responsibility to do what you need to do to get through. Both of us did ultimately, on the academics, we both did ultimately go to college, and I went to University of Cincinnati, got a business degree. My brother Andy went to University of Cincinnati, got a degree in real estate and economics. But even there, it was the goal was to get through so we could start our business. And so going back, it was just kind of not being in love with school and the academics and the idea of corporate America. We were like, well, what's the path, right? We're very driven, we're smart people, but what's the path? And in high school, we had a woodworking shop. We were very good at woodworking. I spent a lot of years kind of tree houses, building things, doing things with my hands.
Yeah.
And woodworking just kind of was a natural area that I was just really good at. It made sense to me, clicked for me, unlike, call it English class or something like that, where it was just always a struggle. And so then I thought, well, how can we use this skill set? Right? Working with our hands, this is where we excel, both me and my brother. And so then I was in high school, he was in college, became maintenance techs for a local landlord, where we were the guy. Actually, how that started, I don't think I've ever shared this, is my brother, who's our COO and co-founder, he knew someone who their dad was a landlord, and so he needed some help from someone who was strong enough to carry furniture out of a building for an eviction set out.
Okay.
And so this person was like, hey, Andy will do it, and he's like, yeah, so I'll make some money. Well, and then so Andy started doing these eviction set outs, and then the landlord would ask my brother, hey, can you hang some blinds up afterwards, or can you do this? And he's like, yeah, I can figure it out. So he started doing it, and then me and Andy were always very close, and Andy started asking me hey, do you want to just come with me to do these things? So there was 2-3 months where Andy and I were splitting his paycheck, and this landlord had no idea that there was two people working, and Andy mentioned to him one day, 3 months after we were splitting, hey, my brother's been doing a lot. Do you think we could potentially, work that out? And he's like, yeah, for sure. So we both then became like maintenance techs, and what we always did was we always said yes, right? So he's like, can you do this?
Yeah.
We would just say yes and like figure it out or watch YouTube, and we just had a natural ability to pick up the trades and figure things out and understand when you look at this is how that does this, and put it together. That then, multiple years being maintenance tech, then grew into like friends and family asking, can you fix this? Can you fix that? Just kept saying yes, kept figuring out, kept doing a good job, kept always trying to learn, watch videos, read, listen to things. And then that grew into like, instead of can you fix this, can you fix that? It was like, can you put a deck on my house? Can you put an addition on my house? Can you redo my kitchen?
Wow.
And we just kept saying yes and kept doing a good job. And we built out a company this would be like 2008-ish. And just kept working hard. And then when the real estate market crashed in 2008, and we started kind of looking around, and we were like, you know what, we're pretty good at fixing these houses. There's a lot of distressed houses. There's a lot of foreclosures. And so we had seen the house flipping shows. And so we were like, let's go try to buy some of these really, really rough houses. And we bought some really rough houses because we didn't have that much money. We were really young. All of the money we were making was just from our construction business. We never got jobs. And because of that, we couldn't get financing. So we had to buy the houses cash and renovate them cash with no financing.
Yeah.
So it was just a slow process of where we were using our sweat equity for lack of capital. But fortunately, we were young enough where, working 12, 14, 16-hour days, it felt like building tree houses in the woods with my brother. Like, it didn't feel any different than that, and it wasn't a big deal that we weren't making any money, or we weren't taking any money, right? We were just taking the money that we made in the construction business and putting nearly 100% of it into buying houses and fixing them up. So I've talked too long, but that gets you from basically childhood to or the first house, and that's how it all started happening.
Do you still remember your very first real estate investment?
Yeah. I mean, the first one was in Lockland, Ohio, not the greatest neighborhood, but it was the reason we bought it is it had a 30 by 50 detached garage, and we were running our construction company, and so basically the only buying criteria was big garage. And it was a 4-bedroom house built in the, I think, early 1900s. And we put 2 more bedrooms in the basement, and Andy and I lived in 2 of those bedrooms and rented out the other 4 to friends. That was the start of landlording. A lot of people call that house hack. And then we began buying other single-family houses and renting them out. Right? We didn't go into flipping until many years later just to generate cash, but we were just landlording the whole time.
Can you talk about how that slowly scaled? I mean, where was the first turning point, I think, where you and Andy looked around and were like, we are doing something really neat here. Let's take it to the next level. Is there any specific event maybe early on that you can think of?
Yeah, I can think of an inflection point, but I think before I get to that, I guess one of the benefits is like we were so young, right? We were either in college or just out of college. And so like all of our peer group, it's like everyone's not making money. Everyone's used to living frugally. And Andy and I were making pretty good money, but we didn't have any kind of like pressure to spend that, and it was just kind of our natural, we come from a great family, but not one with a ton of means, so it was just normal for us, right? I think I shared with the team recently, it's like we didn't have cable TV or air conditioning until we were adults and moved out of our house, right? And so not spending the money we were making was easy and natural for us. But the inflection point was probably 2 to 3 years in. We had acquired and renovated, I think it was 8 houses. And again, this is 2008, 9, 10-ish timeframe. So the banks were pretty much shut down, and definitely shut down to a couple teenagers that didn't have jobs. So we had 8 houses free and clear that were rented out, and we found a little local bank, Valley Central Bank, that gave us a blanket cash out refinance. And that check was more than we had ever seen, and it was like this inflection point, like this works, right? And what we did is kind of the same story that goes on for the rest of the timeline, which is we took that check and we went and bought 10 more houses. right? Like we didn't take a dime of it. And it was like, there's all these like financial advice is like live off of whatever percent, right? Live off of 80% of your income so you can save 20, or live off 50% so you can save 50. And it's like, I don't know what our number was, but it was probably like 95.5.
Okay.
And like I remember going to the thrift store and they had this huge bin of t-shirts that were not good enough to be sold as t-shirts, so they would sell them as rags, and they were 99 cents each. Well, that's where I got my t-shirts to work in, right? Like, so like when we would paint and do drywall and all this stuff, like we just ruin our clothes. So I was getting that. We were living for free because we were doing this house hack. My only expense was like my cell phone bill and car insurance, and you know how you eat in college. It was like food wasn't a huge thing, like a huge expense. So anyway, it was like just a lot of delayed gratification, and that same narrative still lives on today. Is like it was very easy for us to have delayed gratification, reinvest the capital. And that inflection point 3 years in was it was meaningful because looking backwards from that inflection point, it was like, this works, right? Like we knew what we were doing. We were adding value. We were trying to increase our net worth, but we hadn't ever captured it. And it was like that moment we captured it. Then we made the decision to continue our delayed gratification by redeploying it into 10 more houses, which became this compounding effect, this snowball that has grown since, and now approaching 2,000 units in 17 years. But that was a meaningful tipping point.
So we're at 2010 right now in the story.
10, 11 would be like we're at 8 single family houses that are rented out. And we're 100% of the work, right? Like no vendors, no contractors, no employees, nothing, right? We're the leasing agent. At one period of time, we had this old Dodge Ram where the driver's door didn't even work. In the middle of the seat, we had a printer with an auxiliary cord to the cigarette lighter, so that way we could lease and print the leases because nothing was electronic at the time. And so we would have our maintenance clothes on, and then we would go to the truck, change, and then show the house as a leasing agent and print things off. And I mean, it was craziness, but that was what was necessary because at the time we just didn't have the connections, we didn't have the money, we didn't have the knowledge, but all we had was like work ethic. And so it was like, okay, we'll just outwork everybody. That's it. And at the time, not having a family, not having a lot of other responsibilities, it was like, we'll just do it all day long, right? From the time we wake up to the time we go to bed, we'll just work. So yes, 2010, 11 is kind of where we're at.
And then walk me through the next couple of years from there. Did you continue to build your portfolio, I imagine?
And I mean, it was the glory days of buying, right? Like on the MLS, you just go out and it's like, wow, we just toured 15 produce amazing financial returns. Which of the 15 would we like, right? That was what it was like back then. And because there were so many foreclosures, just imbalance in the market. But we started to pick up duplexes and fourplexes, and then we found this fourplex that was very easily converted into a 5-unit building. And then we learned, okay, well, like, wait a minute, 5 units are valued differently than 4 units. Like that's a tipping point in valuation of real estate, where the industry says 1 through 4 is residential, 5 and up units is commercial, and therefore how we value them is different. Rather than comparable sales, we go into income approach. And then we learned like, okay, well, we can actually make this property worth more by decreasing the expenses and increasing the income. We're like, well, we like that. We like control. So then we got on to apartments and made the decision like, okay, and I should say like all of this was our funds, right? No investors at the time. And then we went into this idea of like, wow, we want bigger apartments so we can force value. We like this. We don't want to be reliant on what did that house sell for next door or what did that duplex sell for down the street. Like I want to be able to force the appreciation. And so we decided we were going to try to buy something bigger. At the time, what that resulted in was a 42-unit building called Forest Meadows, which we own today. Multiple $1 million purchase price. We didn't have that kind of money. And so we said, like, how are we going to get that money? And we said, well, what do we know how to do? Let's flip some houses. So this now takes us to about like 2014, 2015. The market is starting to climb back up, come out of the great financial recession. And without hiring vendors, without anything, we flipped 17 houses, just me and Andy. he was a real estate, he got his license, so he was the real estate. I mean, start to finish, it was just us. So
Yeah.
tons and tons of effort, but lots and lots of profit.
How long did it take to do 17 houses?
A year.
A year.
Yeah.
Wow. Okay.
So we did 17 in a year. So we were doing more than one a month.
Wow.
And the profits were great. And we took all of those profits and went right into that apartment building and purchased it without investors and did really well with it. And we realized like, what that apartment community did, all the units are exactly the same, right? All the floor plans are exactly the same, 42 of the same thing.
Yeah.
And what we realized is like, we like control, we like efficiency, we like being able to force appreciation, and we're good at construction. But then this community opened our eyes to like, we can build a process around this where like we're just renovating this same thing and we're leasing this same thing over and over, where up until that point, we built up a decent portfolio of all this scattered side of like, this house was built in 1900 and this one was built in 2000, this one, all different stuff, and you're having to recreate the process over and over. And I think that was the inflection point where it was like, okay, now we can build a process, and then we can bring on team members and start to delegate some of this responsibility. And that was the start of our management company, which then has grown into SNS Management, and then the sister company, SNS Capital Group.
And when did you meet your partner, Coleman?
So that was shortly after that. So in Cincinnati, we didn't know what we didn't know. I come from a family that doesn't have any real estate experience or any entrepreneurial experience. So I started a networking group in Cincinnati to just get people who do real estate to start talking and meet and help me kind of, after 8 years of like just kind of banging my head into the wall and figuring things out, like, hey, maybe we can fast track this and then like meet some people.
Yeah.
And so I started this networking group. It was but it was like kind of used Bigger Pockets as the platform to meet these people. Coleman, our now business partner, was interested in real estate investment, but had taken a different path up until that point. So I'll quickly catch him up to speed. So Coleman's background was that he probably, I don't even know this, but I think he did much better in school, right? He was like a much better student, and then went to BYU to get his master's degree in accounting. Became a CPA, worked at Big Four accounting firms for multiple years, then transitioned into a company here locally called Phillips Edison, which is a now public REIT, which is they do shopping centers, which he there did a lot of their accounting and reporting. And so he took a more like institutional grade path, but also had this interest to do something on his own and more entrepreneurial. So he came to one of these networking groups, and he said to Andy and I, who had already kind of laid some groundwork and had built up a small portfolio, and he said, like, I really like what you guys are doing. You have a skill set that I do not have. I want to, ultimately after we like got to know each other, he's like, I'd like to work for you guys as an accountant. I'll do it for free, and I just want to learn, and then after like a year, I'm gonna go do my own thing. Okay. And we were like, oh, free accounting? Awesome. Like, we're not good at accounting. And so then, we both had business degrees, so we could get it done, but it wasn't our natural skill set. And so then, that relationship kicked off, and what we realized over that period of time was like, man, we have very complementary skill sets, but we also see investing, business, kind of we're on the same period of life, right? Like right then we were kind of like all getting married, having kids, things like that. And so there was this great dynamic that we said, like, let's continue that, right? Like, let's keep that going. And so rather than have Coleman split off and do his own thing, ultimately we came to a structured agreement where he would vest into SNS. Well, it wasn't called SNS at that time, but he would vest in over multiple years. And then our goal was to be a third, because we were so used to just me and Andy being 50-50, and like that's just how our brains work, is like we just want an even split, like we're all here to just do a good job. So we wanted it to be a third, and we found a structure that worked for everyone to get him there. And that was a great decision. Like, I would, looking back, never changed any of that. Like, we couldn't be where we are without Coleman's input, his skill set. And so yes, we're at like 2015, 2016.
And that's where the name SNS comes from, Sturm, Nelson Sturm. Right.
Yeah, I mean, the company, like I would say, if someone asked me like, how long have we been doing this? it's like 17, 18 years, right? 2008-ish.
Yeah.
Because that's when the first property was bought. But that first property, I guess you would call it a sole proprietorship, right? Like there was no company name, there was no LLC, and then like Sturm Home Renovation got formed, which was like our construction company. The first houses that we were buying was under a company called White Wall Home Rehabilitation, which is not a good name, but we didn't know what we were doing.
Yeah.
And then, it had multiple names until ultimately like Coleman came on and we went with SNS. And we're talking origin story, it's funny because when we were naming that, there really wasn't a lot of thought into it. We were like, what domain names are available for basically $1, for free? And that was pretty much it, right? There wasn't a ton of thought into it, but that's the reason for the name is Sturm, Nelson Sturm.
Okay. And this is, you said around 2014, 2015 now?
15, yeah.
Okay. You spent some time in Atlanta. Are we there yet?
No.
No? Okay.
So like we had proven out with our own capital that we really like the apartments. So I talked about that 42 unit and that worked. It worked really well. We enjoy that. We want to do more of that. And this is year 8, right? Like we're pretty far in, 7, 8 years in.
Yeah.
And we're like, we want to do more apartments and bigger apartments, but we don't have that money. So that's when we started to explore this idea of syndication, and Coleman's background, understanding financial reporting, SEC requirements much better than we did. We were more comfortable taking on investor capital at that time.
Yeah.
So we went to the select few people who had expressed interest in investing with us and kind of like went back to them and said, what are you looking for? Half of them said, give me cash flow, give me yield. The other half said like wealth preservation, potential for growth. So then, leaning on my brother's real estate economics background, we started looking at different markets because we were like, Cincinnati is really strong cash flow, great yield, but this like potential for growth and this wealth preservation, not as much, especially 2015.
Yeah.
So we identified Atlanta. We said it's only 6 hours away. Economic fundamentals look rock solid, which in hindsight they were, leading to like 2022. And so we decided, okay, well, if we're going to raise money, let's cater to our investors. And so we did what we thought was the best decision, which was like, we're going to run 2 markets at once, Cincinnati, Atlanta. And the way I know how to run business is be very hands-on. So I was like, I'll move to Atlanta. So me and Andy moved to Atlanta for 2 years, northern suburbs of Atlanta. We tried to buy there for 2 years. This is 2016 to 2018.
Yeah.
The whole time we were continuing to grow in Cincinnati. It was working really well. The whole time in Atlanta, we bought nothing.
Okay.
So we found no investments that we could execute on, whether we were not comfortable getting to the price points they wanted, or we had no competitive advantage. So like we're born and raised in Cincinnati. We know the market really well. We know the people here well. And so it was working here. It wasn't working there. And so 2018, what we realized is we were trying to cater to some investors' investment philosophy, but it wasn't ours, right? And they had earned that privilege, right? They were the wealthier half of those investors that we were talking about, and they had earned that privilege to say like, I don't need yield, I don't need cash flow, I just want to like protect what I've already built up.
Yeah.
That's not where we were, right? Like we were living off of this stuff and like scrounging our way through, and we're like, no, we need cash flow. So we were never comfortable speculating or having a non-cash flowing investment, which means we never could buy anything in Atlanta. So we really got a lesson on like, well, what is our core investment philosophy, which is when I really realized like we want consistent, predictable cash flow. Like that's what we want, and that's what Cincinnati gives. So we packed up our bags and said like, let's focus on what we're really good at, and let's just double down right here in Cincinnati. And since then, since 2018, we've never looked back, right? We never looked out at other markets. We're just like, let's just do this and do this one thing really well. So 2018 and on, it's been Cincinnati. It's been really the same exact strategy, which is buy something, fix it up, force appreciation, strip the equity through some debt restructuring, continue to hold, and move on to the next one, right? So that snowball, that inflection point that we talked about, where we did that cash out refinance of those 8 properties, we do the same exact thing today. We just do it with 100+ unit apartment communities. So we've learned over this 16-year origin story is like, stay in your lane, know what you're good at, lean on your core competencies, and that's what we intend to continue to do.
It does sound like a lot of those early habits, values, skills do translate today to how you hire and the culture you're trying to build here. I think my next question is like, to build off of that, is there any like one lesson or a couple lessons that you still think are most important today at SNS, and how it all kind of comes together back from that first house in Laughlin in 2008?
Well, if people have watched some of those podcasts or potentially our other videos, they'll probably have heard me say this because it is just drilled in my head from those 16 years, is that like the financial returns that attract so many people to real estate and attract us to real estate are supported and generated by the on-site operations, and those on-site operations are supported by the people who work there.
Yeah.
And the lessons that I'm fortunate to have earned over those 16 years is because I've sat in each of those people's seats. So like I've been that maintenance tech, I've been that leasing agent. I know what it's like to be the property manager and get screamed at about something that you can't control. And it's like, I've been the regional manager, I've been the project manager, and how that translates to today and like our culture, our values, and like is I think it earns respect from the people, and it also allows us to build standard operating procedures that are realistic, right? They acknowledge, they're not just based on a spreadsheet. They acknowledge the gray area that can't be seen from a spreadsheet, but only you know if you've been in those shoes. And so like I actually was having a conversation yesterday with a maintenance guy because we were talking about KPIs, and KPIs were not something he had ever experienced in his career, feeling the pressure of like a scorecard. And I said like KPI is key performance indicator. It's just an indication. It doesn't tell the whole story. It's up for us to interpret that number. And like I think tying back to what I just said is like we're very good at interpreting the numbers. So we can tell, you know, when is it actually underperformance, or maybe like where does the root cause of the underperformance lie, so then we can improve, right? And I think that is a privilege we have that then results in really, really clean operations, because we're not solving the wrong problem, right? So I think like in this maintenance guy's example, I'm not jumping down his throat, or someone isn't jumping down his throat like, you're supposed to hit this number and you're not. And he's like, I did 4 AC installs. And it's like, okay, yeah, I get it. Right. So it's like, because I know what an AC install takes, and the people that I've put into place to hold him accountable know what an AC install takes. So that means you're going to do less work orders because you were doing these things that were saving the company money. And I hope that continues to stay part of our culture as we continue to scale. But I think it will.
Well, you've hit on everything I think we've covered from 2008 all the way up to today, 2025.
We went kindergarten.
We went way even farther back. Is there anything that I missed that we didn't talk about today that you think is relevant? We did cover a lot.
No, I think it's just, hopefully it's a story that people realize is like, you know, how I want to be seen is like humble beginnings that are still a part of me. Like even today, I catch myself like I'm like talking to the maintenance team, and I'm like, you know, us, and it's like I'm part of the maintenance team. Like I know they don't see me as the maintenance team anymore, but like in my mind, I'm still that like blue collar kind of humble grassroots beginning, and that's how I want to be, right? So I think if people are assessing who SNS is even at the highest leadership level, CEO, it's like that's who I want to be, right? Like I don't want to take over the world and be super flashy. Like I just want to be known as like a person who delivers the feeling home, does a good job, shows up every day, works hard, and has a company that they're proud of.
Well, thank you for taking the time. This was great. I think it'll be really useful.
Thanks for giving me the opportunity, Steve.
Absolutely. And for those who stuck around this long, we really appreciate it. We hope this is valuable to you. Thanks.